is it safe to assume that real estate is only for the ultra wealthy people? Do you think it's true, or where do you think this idea originally comes from?
Real estate is basically nothing other than one asset class.
People also use places like Dubai and Abu Dhabi as a layover,
Absolutely.
which might also somehow end up saving in a lot of cost of their travel.
Absolutely. We have that liberty of bringing any client and connecting to Dubai. Even if he does not wish to pass by Dubai, he has to pass by it. So that's the beauty of Dubai. If you keep everything in all the right boxes, I think tax is the biggest basket which hits you very, very hard. These days, we think that AI will do our job, and I strictly deny. I believe in RI, which is real intelligence, which we are. You are playing with fire. Client will trust you once, and then once the trust is broken, even the bestest of the buffets of the world can't win that anymore. So
So today we're back with our third podcast. We have the managing director of the SMS group, Mr. Sanjit Banerjee, who will help us with more insights about investing in the right currency at the right time, and also about how the INR AED difference has made a major difference over the past few years. For years, we've known Indian families to have savings through FDs. What is it about this habit that we should actually question right now?
So when you talk about FDs, they are like you're running on a treadmill and you want to reach your destination. The actual thing is you're not moving anywhere.
Right.
So fixed deposit is a very big misconception among safe investors who wants to find safety, that my funds are safe and I am getting a fixed return, whereas actually your money is working and it is not growing.
Correct. Now, obviously, we know that this talks about investments where we are getting returns. But what about places where we invest where we may not even have the same return? It could be possible that it's being depreciated. So how do we go and have a take on that?
So let's pull out whatever you said. So let's talk about a fixed deposit. So if I go back in time, like say 10 years down from here, let's say 2016 January, a client has put around 10 million rupees as a deposit, and the prevailing rate those days were around 7%,
Yeah.
which is gross. So post tax, which will be around 5-ish. The inflation has been like 6-ish. So you're already sitting at a negative territory of 1%. Now that is, I'm talking about in local currency, which is Indian rupees. Now you have to send your kid outside for studies. You need your medical bill to be furnished if you go to Singapore, if you go to US. So then the INR versus the currency of US dollar comes into existence. So which is consistently depreciating on an average of 4.5% for the last 10 years. So if you ask me a cumulative question of last 10 years, how did it perform? So the 10 million rupees deposited in 2016 is minus 63%, which is basis your taxation and all inflation adjusted, and minus 41%, which is US dollar depreciation against the currency of INR. So you are in a 104 minus return. So Mr. Client, I would say that you are in minus 4% after 10 years.
That's really bad.
Yeah, it is.
When we talk about currencies, let's take an example of India and Bangladesh. Over the years, we know how the currency has collapsed badly. Now, for investors in those markets, does the urgency of this conversation look different? And what is it that they could learn differently from others?
So last 20 years, I have been into the banking arena, and I have always alarmed and I always alerted my clients. In my last trip, I repeated the same thing, which I always tell my clients, that I went to India, by the way. So I told my clients investment comes later. First is safety of your currency and devaluation. So you should be forgetting about a fixed deposit safety angle and looking at your currency safety angle. So move your money to a dollar neutral currency where you can at least see then the potential of investment and growth. That's the second stage, because problem is everyone becomes an advisor in these days, but you have to understand the basics.
Correct.
If your money devalues, even a 10% return doesn't make sense today.
That's true. So you spoke about evaluating and the stability of currency. Now, how often it is that you see that the investors actually have put a price on it, and why do you think that the stability of the currency is so important?
Problem is they don't understand until and unless they get hit by the losses. So if you talk about PPP, which is known as purchasing power parity, so
Correct.
that is always in copy and books and internet. I have never seen a client coming up to us and asking that what is my risk adjusted return, which we have to communicate to the client, because I have been into investment banking, so I understand that in and out. So yes, client gets the hit without even knowing the consequences. So I think every client should be aware of what's going around. Geopolitics has been into the conversation of every podcasters, every broadcasters of the news. So we should be very very mindful that where is your currency, where is your money, and what asset it is holding right now.
To put this in a numbers aspect,
Mhm.
let's take two companies side by side. They have the same starting capital. Now, what are the variables that you think would actually make differences, and what parts do you think would be different if you compare this in a 10-year span?
So if you just take the USP of Dubai, they say, Habibi, come to Dubai. Why they say that? Because it is a safe haven, not only in terms of your money not degrowing against dollars, because AED is pegged to dollar at 3.673,
Correct.
and you have assets to invest in where you do not incur income tax, capital gain tax. So now, if I draw a line between an Asian country investor and an investor, and the same investor putting partially here, say Dubai, and if you draw a line and make a 5 years comparison, I think you are way way apart if you talk about the balance sheet of both the assets. May it be any investments in a stock market, maybe a property, maybe a gold, maybe any assets, because at the end of the day, when you are redeeming or when you're realizing the profit, it is to do with your dollar net return, which is the ultimate bank account credit comes to the account.
Correct. You briefly spoke about tax. So we know how tax efficiency is something which a lot of people talk about these days. Now, how much of a role do you think it actually plays in real outcomes against the people who talk about it but don't actually calculate it?
Let me talk about my last to last trip, which was in London. So we have our new office in London, which is in Harrow. We have inaugurated the office in pre-war scenario, which was February. So all the conversation with my tax consultant in UK and all the clients based there is predominantly revolving around the same thing. How can I make my investments more tax efficient,
Mm-hmm.
not doing any wrongdoings in the as per jurisdiction specific, because you have to see the legality of the funds, you have to
Correct.
see the source, you have to see the entirety of the investment. If you ask me as a banker, the compliance comes first. So if you keep everything in all the right boxes,
Mm-hmm.
I think tax is the biggest basket which hits you very very hard.
That's
May it
true.
be inheritance tax, may it be a capital gain tax, and obviously income tax. So, yes, it is the biggest basket.
That's true. And obviously, when you take it to an international level, the scales vary a lot. Now, obviously, now that we're talking about international investments, real estate, it we can is it safe to assume that real estate is only for the ultra wealthy people? Do you think it's true, or where do you think this idea originally comes from?
So, actually, if you ask me, so real estate is basically nothing other than one asset class. Like you have stocks, bonds, like you have golds, commodities, like you have currencies. Real estate is an asset class. Why real estate is considered a safety? Because of its tangibility. Because
Correct.
if everything goes wrong, my friend, I can stay inside it. Having said that, you now we are talking on a broader arena where we are managing responsibly few hundreds of millions, maybe in billions, we manage as a group company. Then we have to go back to the client and answer a very simple question, that irrespective of what you said is how much ticket size you are entering at,
Mhm.
which Dubai has played a significant role making a off-plan market work so well that India has started copying Dubai. London has started, Hong Kong has started, Singapore has started. If you go deep beneath the roots, it is the purpose is very simple, that everybody should have the accessibility.
Correct.
If not a hardcore asset, then why not a crowdfunding route? Which is even more cheaper. So you have 500 dirhams today, you download few apps which are regulated by DIFC, you are an asset owner. So it is a fractional ownership, however you are still a real estate owner. So yes, it does not matter how much money you want to put in. It matters what amount of capital, what percentage of allocation you want to put in. So if you have $100, you should invest at least 20, $25 in your real estate basket.
Correct.
That's an optimum like thumb rule of a wealth management.
So, in this conversation, we can come up with the dilemma of playing it safe. Now, it's something which people still don't talk about a lot, but do you think it is actually the safe choice by trying to play it safe, or do you think it is a more rather riskier one in the long run? What is the tension of the risk of actually doing something or risk of not doing anything?
Okay, so looking back about safety and looking back about guarantee, I always tell my clients, and I would love to tell the audience, that there's nothing called safe, there's nothing called guaranteed in this life, because we know one thing is for sure, that we will pass away one day. So that's guaranteed. Only thing that is guaranteed is that we will be no more after a few years. So, having said that, safety is a misconception. There is nothing called safety. If you are talking about Dubai market not doing well today,
Mm-hmm.
I will strictly deny Dubai market is doing well. Yes,
Correct.
there is a little break to the momentum which was happening few months back pre-war scenario. But what has happened actually is people has been attracted by all these asset bearing things which Dubai has on the platter. So if you talk about risk versus your diversity versus your geographical
Comfort.
comfort, or you say the your movability. So why it is known as Middle East, you have to understand first. So Dubai, if you take a 7 hours flight all across, you cover at least 67% of the globe.
That's
So
true.
I would put my business over here rather than any corner of the world, which may be very, very progressive in paper, but after tax and after everything, maybe my risk looks less. It doesn't make sense in piece of paper. We are finance guys. So for us, safety comes first. But having said that, at what cost? So if the cost is, as I said, minus 104%, that safety is not required.
That's true.
So I can't kill my money sitting on a fixed deposit or a bank account for years together, consoling myself that yes, I have some amount which is coming in, whereas the inflation is kicking in, your safety is gone for a toss.
True. We can also say safely that Dubai, as you mentioned, is a 7 hour flight from everywhere in the world.
Correct.
And that's why people also use places like Dubai and Abu Dhabi as a layover,
Absolutely.
which might also somehow end up saving in a lot of cost of their travel.
Absolutely. Emirates itself flies to 196 destinations. So we have that liberty of bringing any client and connecting to Dubai. Even if he does not wish to pass by Dubai, he has to pass by if he boards Emirates. So
It's
that's the
true.
beauty of Dubai.
That's a very well said thing. Following up about the investments in India. Say, for example, you have a client who's been living in India almost all their life, and they have children who wish or aspire to study abroad or migrate abroad. Now, if they have been considerably just saving or investing in FDs, what do you think would be the difference, say, 10 years from now?
So first of all, I'll correct it. Not one of my clients, many are there. So
Okay.
yeah, so yes, that is a perennial problem, which is again a mind blog. So when you say I have a 14-year-old kid or a 13-year-old kid, boss, what are you talking about? I have a 10, 20 million in my deposit. And 10 years down the line, she or he will go to the Harvard. Fantastic. Congratulations, Mr. Client. But have you seen the 104% minus, which we went through the calculation just what we were talking
True.
about? So you mean to say after 10 years, whether it is your kid going towards a university in US, Canada, Australia, wherever, you are exposed to a currency which is other than INR, and you are being battered every year without even you are like you are not considering or you are not factoring in any of the impacts on your currency. So what happens is, as per purchasing power parity, the thing which you were buying 10 years back at $10 has already become $100. So in that sense, you are standing even worse than what you were 10 years back. So technically, today's fees of Harvard may be around 250,000, quarter of $1 million. So now 10 years down the line, Mr. Client, it will be 400,000 US dollars, whereas your money is going back and the fees is moving front. So the gap,
Yes.
that's our job. So to mitigate the gap, we have all the nuts and bolts to make the bridge stronger so that that journey can be made easier. That's what.
So, do you think it would be better for that client of yours to invest in assets in India or the currency in India or even say some certain stocks? Or do you think it would be better to invest in something which you probably know has a better level, but you just have no idea about it?
So look, if you talk about a guy who has a lot of assets in their home country, I'll not be specific to India. If you have the assets which are doing well, I will not touch them.
Mhm.
But if you will not have all the assets doing well, you have to set aside some money for your medical emergency, for your exigencies and all these. You should have at least everything apart 20% cash at all times. Rest of it, you legitimately move the funds out. We will help you. Our accountants are there. You have to have a dollar neutral exposure where, in any case, if you need it tomorrow, it's available either at one click or in a 7 days or a 10 days period. So that gives you an edge over other of your investor friends, where you at least have accessibility to the global markets. Because if you talk about Bangladesh, it's a capital control country. If you talk about India, we are a partially convertible currency country. If you talk about sterling, it has depreciated quite a lot from the Brexit days. If you talk about Aussie dollars, they are a commodity linked currency. So it is haywire. So if you see a dollar neutral currency, which is like a AEDs of the sort, it is, I don't think so. You can't find a better alternative to that.
Especially in the times we know there's no certainty about anything nowadays, actually.
Absolutely.
10 years from now, what do you think the person who played it safe with their FD is going to wish they could have done differently?
First of all, let's talk to that guy and let's move his money out of deposit today. 10 years down the line, I do not have a crystal ball. However, I think I'll keep my conversation back to the basic norms, which is the thumb rule of global wealth management, which is diversification. So if you have $100 wherever you are, in UK, you are in US, you are in Canada, you are in India, so at least 40% of your wealth should be well diversified apart from your business and your ongoing expenses today. So
True.
say that guy of the fixed deposit client, he sets aside 40% of his wealth, say example Dubai, and he parks into a very safe kind of a bet, maybe a commercial real estate, which pays him a 7 8% 9% rental, which gives a rental yield in dollars, by the way, which accumulates to around 20% in INR terms, or a Bangladeshi taka 30%. So that you have to keep into consideration. So I think diversification is the key. You have to spread the risk. So more the merrier is also not required, because too much of diversification dilutes the portfolio. So you should have a right mix, right assets. So we have a very, very capable and competent team. We spearhead a lot of analysts. We have AI guys who help our clients on a daily basis. That how do you park your money, where do you park your money, and when do you park your money. So these are the right questions, rather than we move around and find safety.
That's true. Before anyone would take action based on our conversation, what do you think is the right thing to do? Well, do you think we should move fast, or do you think they should hold their position and wait for the right moment until someone actually reliable tells them to make a move?
So very well said. So now these days, every client is asking me, Dubai is 20% down, 30% down. Let me take you back in time. So when the Lehman Brothers crashed, so I was in Bahrain, I was in Citibank. So I thought the world has come to an end. Then the time went by, and I thought that yeah, we will recover, and we did. So and we entered into the interest rate crisis, which was 2014, and then we entered into COVID, and then we entered into a war scenario. So if you spread the timeline and see the trajectory, it has always been up. So as Warren Buffett says that invest forever.
Correct.
So that is not what I am telling today, but I am saying that at least you should understand that all the markets in the world has cycles. So yes, you should run at a steady pace rather than moving too quick today, holding on to your assets. We can't time the market. We have to be in the market to understand the market. So example, if you want to be an early entrant to a property market, you can't keep waiting. You have to take a call someday, and it is not that you have missed the bus. So I told one of my client that you are saying that Dubai is finished and everything. So I said in a very a different manner. So I said, if you are in an aeroplane and you're flying at a like 10,000 um, uh,
Feet in the air.
miles above the air, so and there is a turbulence, what do? You just get up, take the parachute and jump off the plane? You don't. You wait, you trust the pilot, and you wait for him to sail you through and take you, glide you throughout the entire turbulence. So that's what we have to do. We have to just sail through all the uncertainties, but does not mean we have to be in cash. You never know, even cash can devalue, which we were discussing now. So yes, asset diversification, timing should be yours. When you are ready, it is the time for investment. It is not that investment will wait for you and the markets will wait for you. So that's what is happening. So everybody anticipated that the AI bubble will burst, and the S&P ran 40% up. SpaceX is still way above the opening price. So that's what we can't control the markets.
It's true. But we can understand that reliability and timing are very important in this.
That's why we are present. So we as a consultant, we assure our clients that if we are beside you, we will give you all the market insights, the dynamics, the risks pertaining to the timings. Because look, if you are a businessman, you will not understand what we go through, because we handle so many portfolios with distress, with so many things. So we always tell our clients, please reach out to us. We are there. We will sit down with you, with your finance managers. We will sit. We understand balance sheets very well. We understand portfolio statements. Whichever bank you are banking with, Bank of Singapore, SocGens of the world, we will analyze, and we will tell you that whether we are on the right track or we can little deviate from the track.
Definitely. Lastly, I want to ask, if you were to start over again, what's one thing that you think you would do differently from back when you started in your time?
So again, I will defy what I said. So I will try to time my thing, and I want to be a banker much before than what I was. So I would be seeing myself as a banker in the 1970s, because
Okay.
I think we are missing the basics. These days we think that AI will do our job, and I strictly deny. I believe in RI, which is real intelligence, which we are. So I don't think that existed in those days. So if I take myself back in 1970s and see man to man banking, that is heart to heart,
That's
because
true.
that is very important. This is missing
That
in today's
sense of
world.
connection is very
Yes,
important.
so if you talk about today's market, everybody is a broker, everybody is an advisor, everybody is doing whatever they wish to without the respective qualification. That really hits me hard, because you are playing with fire.
Right.
Client will trust you once, and then once the trust is broken, even the bestest of the buffets of the world can't win that anymore. So that's the dilemma of the market. That will remain, because the population is growing, and the world is moving towards AI dynamics. But yes, answering your question, I would go back in time and again be a banker.
Okay. That's very well said. Thank you so much, sir.
Thank you. Pleasure.
Now, we have understood the importance of the right timing of the currency, real estate, where to invest, how to invest, and who to trust. So, stay tuned for our next episodes where we will be giving you more insights and more information which could be more helpful for you.